I'm Ant Gould for AM Best TV at the Insurance Market Briefing Europe in London. Now, joining me to talk about assessing trends and changes to AM Best credit rating methodology are Mahesh Mistry, Senior Director Analytics at AM Best, and Jalpa Thanky, Senior Financial Analyst at AM Best. Welcome to you both. Now, Mahesh, can I start with you? What would you say are the key highlights for the distribution of ratings in the EMEA?
Yes, so out of London and Amsterdam, we look at ratings within Europe, Africa and the Middle East. When we look at the composition of our ratings, within the mature markets, we see that the midpoint of our ratings is around the A minus range. We do have a few ratings higher than that, and then they seem to tail off with a few ratings within the non-investment grade category. When we consider the emerging markets, we see more of a wider spectrum of ratings there, with the midpoint around the BBB minus, which is borderline secure, non-secure ratings. We find that the CRT3s are generally on the higher side, and as we move into the more riskier countries in CRT4 and CRT5, they tend to move more into the non-secure category. Now, when we look at our ratings, around 85% of them have been affirmations during the year. There have been some notable upgrades, mainly due to structural changes of organisations or rating enhancements for certain subsidiaries. In addition to that, there have been companies who have shown improved performance. On the downside, we've seen some restructures which have created some negative rating actions, and reduction in capital also taking effect.
Jalpa, perhaps I could bring you in here. So how important is Best's capital adequacy ratio to the balance sheet assessment?
The Best Capital Adequacy Ratio, or the BCAR, is significant when it comes to the balance sheet strength assessment. However, it is not the sole determinant for the overall balance sheet strength assessment. It provides a starting point for the assessment, but we incorporate additional factors into this, including the financial flexibility of a rating unit, its fungibility of capital, results of any stress testing analyses, investment portfolio considerations such as the liquidity of a portfolio or asset liability management, as well as reserve quality, for example, amongst other factors. So the BCAR provides a starting point, but is not the only component that we look at, and therefore you could have a BCAR assessment at the strongest level, but your overall balance sheet strength assessment can be lower than this.
Thank you. And what are the key building block differences between the mature and the emerging markets?
So every company is unique in its own right, and our rating assessments therefore look at our rating units on a case-by-case basis. However, if we look at it more generally, when we look at balance sheet strength, for example, the BCAR scores for companies in both markets tend to be at the strongest level, but when we look at the other components that I spoke about earlier, we see that the balance sheet strength assessments for mature markets tend to be concentrated in the very strong and strong categories, whereas for the emerging markets they're more well spread. Moving on to operating performance, we see that generally the operating performance for mature markets is slightly better than those in the emerging markets, primarily driven by better risk selection and better operating cost control in the mature markets. Moving on to the business profile, emerging market companies tend to be less well diversified and have a smaller scale, and therefore have less positive assessments when it comes to business profile, and similar on the ERM, because the mature markets tend to benefit from sophisticated models when it comes to capital management and their risk management tools.
Okay, thank you. And Mahesh, what factors will impact rating movements over the short to medium term?
Yeah, that's a very interesting question. It's what everybody wants to know about what's going to happen going forward. Ultimately, companies are unique in their own right, and at the end of the day, it's up to the rating committee to look at the factors that are affecting these companies to determine whether there is going to be any positive or negative drivers at the end of the day. When we look at what's happening in the market, the competitive landscape is changing. You've got geopolitical tensions out there as well. So there may be market events where the analytical team need to look into more detail to ascertain what potential impact these events would have on companies. When we look a little bit more closely at our outlooks on our ratings, and these outlooks can be there for up to 36 months, a lot of them are down to balance sheet deficiencies at this point in time. So we have quite a few negative outlooks relating to risk-adjusted capitalisation. So I think it's important to understand that operating performance and balance sheet is going to probably be critical over the next few years in terms of determining the sustainability of some of these ratings going forward, and how companies are going to adapt to the environment over the next few years.
Thank you, Mahesh. Thank you, Jalpa. Certainly some challenges ahead. I'm Ant Gould for AM Best TV from the Insurance Market Briefing Europe in London.